Hello, everyone. I hope you're doing exceptionally well today. Today, we're going to be talking about whether or not you should be using cash that you have saved or if you should be using your infinite banking policy. Now, this isn't necessarily going to be a video about whether you should store cash or do the infinite banking concept. This is really going to be looking at what if you have a policy already set up plus you have some cash sitting in your bank. Now, there's going to be some assumptions, I guess, we're going to make. We're going to be assuming that you currently don't have any outstanding loans and that your cash is sitting there and not intended for any particular purpose. Now, I'm going to be mixing this up with a real world example. So, when you look at the infinite banking concept, everyone talks about the velocity and movement of money, and that you take out policy loans, fund your ideas, and then have this revolving cycle where you've got your infinite banking concept, you've got your I'm going to call them purchases slash investments, and ultimately you use your IBC policy to fund these purchases and investments, and the payments that you would have otherwise made by financing these things go right back into your infinite banking policy, creating this ever perpetual system whereby you are quote unquote recapturing the interest. And all that really means is that you're paying interest to an insurance company at a simple basis, and your IBC policy is continuing to grow despite the fact that money is being borrowed against it. So that's kind of the concept here. And I have a real world example for you because this is something that I had just gone through. I was looking to make some improvements to my house and install some equipment. And the equipment taxes in was going to be $10,350. And so I had a few choices that I could have picked. So let's just do equipment. Okay. So we have equipment. I could have leased the equipment. Now, there was no quote unquote financing option, but you can assume that this also can include financing as well. I could have used my own internal financing that would have been available, and then I could have also used the cash. Now, when I broke this out for myself, and I do want to take a second to say here that sure, there may be an optimal mathematical way of doing this, but not everything is math, and that's really where the infinite banking concept really shines. Is it allows you to use a lot of human elements and simplicity to go ahead and kind of optimize and maximize things without having to worry about all of the nitty grittiness that we've talked about in future, rather past videos. So in my case, I didn't want to have to go and apply for financing, traditional financing from a bank. The main reasons for this have to do surrounding the credit aspect. I didn't want any inquiries. I am going to be making some moves with my credit and want to make and maximize that for the time being. And so, because I have already had in the past leasing with this equipment company, they were willing to lease me out this equipment. Now, the problem is with the leases and how this was written is that they were going to capture all of the interest regardless if you were going to have to pay it up front. And so this is really a fixed cost. The prescribed interest rate that they were going to do this was 7.2%, which ultimately is a fairly decent rate for equipment financing, and it would have been on of course, a secured basis, which is fine. If I would have done the unsecured route, I probably would have got 10% rate. That seems to be the unsecured lending route. I could have used pre-existing lines of credit that I already have. There's a whole different ways that I could have done this. But what would have occurred is some manner of a fixed cost that required to go to either the leasing company or the bank on a monthly basis. My infinite banking policy, I had more than enough funds available in order to cover the entire cost of this. This isn't a fixed cost, but it does bear interest, approximately 6.5%. I'm rounding up here, but approximately. So it would have been cheaper than the lease. And so right away, the IBC policy already looks better and it is flexible and, of course, continues to grow. But remember, it continues to grow regardless of the option that I end up picking. And then ultimately, I had cash sitting in the bank. Again, I had more than enough cash in order to satisfy the equipment. Right now, I'm in a acquiring mode, hence why I'm looking to preserve credit. My goal is to go and buy another investment property. I'm going to be financing some from a bank and leveraging my IBC and my cash for the down payment. The reality is I dislike holding cash because cash yields very, very, very low returns. And so it's not something that I intrinsically like doing. However, when we look at the cost basis of everything, if I would have leased it, of course, I would have had a fixed cost. Interest would have been built into the lease, meaning if I paid it out early, I wouldn't be advantaged in any way, shape, or form. So I really didn't like that idea. So it came down to using my IBC policy and keeping my cash, or using my cash and keeping my infinite banking policy. Now, the idea behind the infinite banking policy is that, of course, you borrow from it. It's super flexible. The interest rates are very competitive. And so I could have financed this over a 2-year period. Now, I would have gotten some rebates back from some governmental programs. So my actually all-in cost would have been about $6,000, but you don't get that back for several months. And so ultimately, my thought process behind this is if I'm comparing the apples to apples, my cash would have cost me 0%. I would have used the resource. However, if I used my infinite banking policy, I would have got charged interest. My cash, of course, wouldn't make any money. So my real cost would have been the 6.5%, regardless of the option. Remember, the infinite banking policy would grow regardless of what option I would choose. So my actual true cost would be the 6.5%. I opted instead to use the cash because my fixed basis is 0%. And if I ever need this cash again, well, then I can leverage the infinite banking concept to then go and replenish my cash stores. And so when I compared the two options, if we look at kind of the interest charged and time, one of them would have had my interest charged at the 6.5%, roughly speaking, right away. And of course, over time, this would decrease because as you pay down the loan, your cost of interest reduces. Whereas with my cash, I pay no interest. And if I ever, for whatever reason, require money in the future, well, then I would start paying the interest back. But I would defer this cost of this interest right here. And that assumes that I do need cash, which at this moment I don't. This is kind of the thought process that I went through. So when I consider things, if you have cash sitting in the bank, what should you do if you have an infinite banking policy? I would always leverage that cash first and then use your infinite banking policy afterwards. Now, with all videos, of course, I'm not a financial advisor or anything of the sorts. I'm just a guy that loves finances and I love the infinite banking concept. If you disagree with what I've said here, please put it in the comments below. Let me know how you would do it. I don't claim to be this quote unquote expert. And so I'm always looking to learn every day. Hopefully I can learn something. So thank you very much. And we'll catch you in the next video.